The world woke up on June 13, 2025, to alarming news. Reports confirmed that Israel had conducted military strikes against several important sites inside Iran. These sites were connected to Iran's nuclear program and missile facilities, making the situation extremely serious. This was not just a small event, it was a major escalation in the long-running conflict between the two nations. Instantly, people all around the globe started to worry about what might happen next. The possibility of a bigger war, one that could involve other countries and disrupt global stability, became a very real fear for many observers and market participants. This kind of news creates a powerful feeling of uncertainty. When people are unsure about the future, they tend to become very cautious with their money. Investors, both big and small, start to think about safety above all else. They look for ways to protect their wealth from potential chaos. This often means selling assets that are seen as risky or volatile. In moments like these, the appetite for making big, bold investments disappears almost overnight. Instead, a risk-off mood takes over the financial markets, where the primary goal is to avoid losing money rather than to make a profit. The cryptocurrency market is known for its high energy and big price swings, which makes it particularly sensitive to global events. When news of the strikes broke, this digital asset space felt the shock almost immediately. Investors in Bitcoin, Ethereum, and other cryptocurrencies saw the headlines and reacted quickly. The fear was that a widespread conflict could damage the global economy, making people less willing to invest in new and innovative technologies like crypto. This initial wave of nervousness was the first domino to fall, setting the stage for a dramatic reaction across the entire digital asset landscape. This reaction is a classic example of how real-world events can directly influence the digital world. The conflict wasn't happening on the blockchain, but its consequences were felt there deeply. The threat of war in the Middle East, a region critical for global energy supplies, made investors quickly reassess their positions. They began moving their funds out of assets they perceived as speculative, like crypto, and into things they believed were safer, such as government bonds or gold. This sudden shift in sentiment created a wave of selling pressure that would soon become visible in the falling prices of nearly every major cryptocurrency. The impact on cryptocurrency prices was both swift and severe. Bitcoin, the largest and most well-known digital currency, experienced a significant drop. Its price fell by as much as 5.5% in a very short period. Before the news, Bitcoin was trading comfortably around $107,000. But as panic spread, it quickly tumbled down to a low near $102,800. This sudden decline erased billions of dollars from its total market value. While the price did stabilize a little later around $105,500, the sharp drop showed just how nervous investors had become about the unfolding geopolitical crisis. While Bitcoin's fall was significant, other cryptocurrencies, often called altcoins, fared even worse. These smaller coins are generally considered riskier than Bitcoin, so they often see bigger price swings during times of market stress. For example, Ethereum dropped by about 7%, and Solana fell by a similar amount between 7 and 8%. Other popular coins like Cardano and Dogecoin also saw steep declines. This widespread sell-off showed that the fear was not limited to just one asset. It affected the entire crypto ecosystem, pulling the total market capitalization down by a staggering 3%. A key reason prices fell so fast was due to something called liquidations. Many traders in the crypto market use leverage, which means they borrow money to make bigger bets on whether prices will go up or down. If you bet on the price going up, a long position, and it suddenly goes down instead, the exchange can automatically sell your assets to cover the loan. This forced selling is a liquidation. When the news from Iran broke, the sudden price drop triggered a massive wave of these liquidations, forcing even more selling and pushing prices down even further and faster. This cascade of liquidations created a dangerous feedback loop. The initial price drop caused by nervous investors triggered the first round of liquidations. These forced sales added more supply to the market, which pushed prices down even more. This in turn triggered another round of liquidations for traders who had set their safety nets at slightly lower prices. This domino effect is why the market can seem to fall off a cliff during moments of panic. It's a harsh reminder of the risks involved with using leverage, as many traders who were betting on rising prices lost all of their invested capital in a matter of minutes. While the sudden market crash was scary, it was not the first time something like this has happened. The cryptocurrency market has a history of reacting strongly to major geopolitical events. Looking back at similar past situations can offer some valuable perspective. For example, in October 2024, the market experienced a similar shock when Iran launched a missile attack on Israel. On that day, Bitcoin's price dropped sharply by 8.8%, falling to around $60,500. Many people feared that this was the beginning of a much longer downturn for the digital asset space. However, what happened next was remarkable, and gives current investors a reason for cautious optimism. Following that dip in October 2024, Bitcoin did not stay down for long. Instead, it began a powerful recovery. Over the next 2 months, its price rallied by an incredible 80%, eventually reaching a new high of about $108,365 by December 2024. This historical example shows that while Bitcoin is vulnerable to initial shocks from bad news, it has also shown incredible resilience. The market has often managed to bounce back stronger than before once the initial fear subsides and cooler heads prevail. Market analysts who study these patterns have noticed that Bitcoin often follows a predictable cycle during these events. It tends to experience a sharp, painful drop in the immediate aftermath of a conflict or political crisis. But historical data suggests that it typically recovers from these dips within about 50 days. In many cases, it doesn't just return to its previous price, it often surpasses it, setting new records. This pattern suggests that some large investors, often called whales, use these moments of panic as opportunities to buy more Bitcoin at a lower price, a strategy sometimes called buying the dip. This recent event on June 13, 2025 seems to be following a similar script so far. After its initial fall, Bitcoin quickly bounced back above the $105,500 level. This price point is important because it represents a key technical support level known as the 50-day simple moving average. The price tested this level and held strong, just as it did during the October 2024 event. This technical strength, combined with on-chain data showing that large investors are accumulating more coins, provides some evidence that history might be repeating itself, potentially setting the stage for another recovery rally. Every time a crisis like this happens, it reignites a major debate within the financial community. Is Bitcoin a safe haven asset? A safe haven is an investment that is expected to keep or increase its value during times of market turmoil. Gold is the classic example. Some people argue that Bitcoin should be considered digital gold because it is decentralized and not controlled by any single government or bank. They believe this makes it a good place to store wealth when you lose trust in traditional financial systems, especially during wars or economic instability. On the other hand, many experts disagree and point to events like the recent crash as proof. They argue that in moments of true panic, Bitcoin behaves more like a risky technology stock than a safe store of value. When investors are scared, they sell their Bitcoin holdings to get cash, or buy more traditional safe havens like US government bonds or physical gold. The price action on June 13 supports this view, as Bitcoin's value fell sharply alongside other risk-on assets. This shows that, for now, the broader market still sees cryptocurrency as a speculative bet, rather than a reliable shelter from the storm. The truth is likely somewhere in the middle. Bitcoin's role in the global financial system is still evolving, while its decentralized nature offers a compelling long-term argument for it being a store of value. Its short-term price action is still heavily driven by the behavior of speculative traders and its correlation to traditional risk assets. It may one day achieve the status of digital gold, but its high volatility means it is not there yet. For now, it seems to be an asset with a split personality, a potential long-term hedge against inflation and government control, but also a short-term risk asset that suffers during risk-off events. As of today, the market is showing tentative signs of recovery. Bitcoin has reclaimed some of its lost ground, and the initial panic appears to have eased. However, the situation in the Middle East remains incredibly tense and unpredictable. Traders and investors are watching the news very closely, as any new development could send another shockwave through the markets. The path forward for cryptocurrency prices will likely depend heavily on whether the conflict escalates further, or if diplomatic solutions can be found. The recent chaos serves as a powerful lesson that the world of crypto does not exist in a vacuum. It is deeply connected to the unpredictable events of our world.